Look at this chart. The S&P 500 is soaring past 6,000 points like a rocket launch. It's mind-blowing. Just 7 tech stocks make up the third of the entire S&P 500. And some have PE ratios over 100. And many of my clients ask, Maurice, are stocks overvalued? Or should we wait for a dip? These fears can lead to missed opportunities. So the question is, if you have money waiting on the sideline, is waiting a smart move? Let's strip away emotion and take a data-driven look at whether investing in broad market ETFs still makes sense at these prices. But first, let's set the stage with some context. Let's take a look at the Welshire GDP ratio for a second. Warren Buffett, the oracle of Omaha himself, once called it probably the best single measure of where valuations stand at any given moment. Right now it's sitting at over 200%, and it's a sign that things might be getting a little hot at the moment. But hold on, before you hit that sell button, we need to consider something crucial. The S&P 500 isn't the same beast as it was even a decade ago. Back then, in 2005, ExxonMobil was the big dog in the yard, right? And now it's all about tech giants like Apple and Microsoft. This shift in companies is huge, and it's changing the game when it comes to how we look at traditional valuation metrics. While the Welshire ratio gives us an immediate snapshot of market heat, the CAPE ratio helps us understand the historical context. The cyclical adjusted price to earnings CAPE ratio smooths out earnings over an entire decade. Right now in 2025 it's sitting at over 38 compared to just 8.35 in 1982. And this might make stocks seem extremely overvalued today, right? But first, if you enjoy videos like this and want to discover smarter and faster ways to build your wealth, even if you are not there yet, be sure to subscribe to my channel and stay up to date. But hold on, because when we zoom in on the last 10 years, suddenly 38 doesn't seem so extreme. The average CAPE ratio has ranged between 24 and 38 over the past decade. So while today's valuation is on the higher side, it's not necessarily an outlier in recent history. So what does this mean for you and your hard-earned cash? Are we in a bubble that's about to burst, or is this the new normal? The truth is, it's not as simple as yes or no. The market has changed, and our tools for measuring it might need an upgrade. Remember, just because something looks expensive doesn't mean it's overvalued. These tech giants dominating the S&P 500 aren't just making money, they are revolutionizing entire industries. They are creating value in ways that traditional metrics might not fully capture. But that doesn't mean we should be a little cautious. When the S&P is hitting all-time highs with years like 2023 with 22.3% and 2024 with 22.7%. But still, the key is to be smart, stay informed and think long term. Don't let emotions cloud your judgment. Instead, use this knowledge to make smarter choices about your investments. What do I mean by this? So, if you are thinking about waiting on the sidelines until the market cools down, hold that thought. Let's take a trip down memory lane to 2017. Remember those headlines about overvalued stocks in the news? This is what Goldman Sachs told you in 2017. Any way you look at it, this stock market is overvalued. Or CNN, caution, US stocks have rarely been this expensive. They were all sounding the alarm bell, warning investors to be cautious. And they love this type of news because it makes investors glued to their screens, watching this type of news. Now imagine you would have listened and decided to step out of the market. What would have happened to your portfolio? From 2017 to 2020, the market kept climbing. But then it happened. There was the COVID crash in 2020 and the market went down. But wait a minute. As investors who stayed in the game from 2017, hearing the news screaming all about all-time highs, you still had a juicy 20% return if you had stayed invested. And after that, the market bounced back really hard to where we are now, a new record-breaking high at 6,000 points. If you would have been hanging out on the sidelines all this time, you would be probably kicking yourself right about now, right? But don't beat yourself up. Just be smart and take the right decisions for the future. The real question here is, what can we learn from this to make smarter choices going forward? Therefore, I have a mind-blowing fact for you that a lot of investors don't know. Historically, the market goes up 75% of the time and only dips 25% of the time. That's right. Over the long haul, companies tend to grow, make profits, and reward the shareholders. It's not always a smooth ride, but the trend is always your friend. And this has been the same for over 100 years now. So should you try to time the market?
The bad years, the crisis years, the Dow dropped by about 50%. And since then it's, and people panicked and got out, of course, even in the mutual fund business, and particularly in the ETF business, a lot of net liquidations at the lows. And now we're back. I think the gain from that level is maybe 200%. So it shows you that when you act on the emotions of the marketplace, you're making a big mistake. I stay, and always have said, stay the course. Don't let these changes in the market, even a big one, that was a 50% decline. Don't let that change your mind. And never, never, never be in or out of the market.
So it's clear that timing the market is like trying to catch lightning in a bottle. Even the pros can do it consistently. So instead, if you have a lot of money on the sidelines, this is what you should do. That's where this tried and true strategy of dollar cost averaging comes in. Dollar cost averaging isn't just about playing it safe. It's about giving yourself the freedom to invest without a constant worry. You are not trying to outsmart the market, because you can't. See how you're spreading your bets across different price points. Instead, you are playing a long game, and history shows that's where the real money is made. By investing regularly, regardless of market conditions, you are spreading out your risk and potentially catching those upswings when they happen. The key takeaway here is, in the world of investing, it's not about timing the market, it's about time in the market. But then I still have clients who say, but Maurice, I'm in my 60s now and all my money is already invested. I can't dollar cost average anymore. And it's a common concern as retirement approaches, right? And many feel uneasy knowing that over 30% of the S&P 500 is concentrated in the tech sector right now. They still remember the dot-com bubble, and that memory should make you nervous as well. So if you are feeling this way, maybe there is a smarter way to reduce your risk while still growing your wealth, and that is dividend ETFs. These ETFs come with 3 powerful advantages, what I will tell you more about in this video. I will share my favorite dividend ETF, one with a proven track record that has been crushing it lately. It might just be the key to weathering any market storm. So what's your strategy as we hit all-time highs? Are you staying invested or stepping aside? Drop your thoughts in the comments below and see you in the next video.